let's look at the dollar index, okay? We have the daily on the left. I can't see your comments or questions. I'm putting you back over in the corner, so I can't see you. So please don't waste your time sending anything. I'm going to get through this and get back to doing my lessons for this weekend's delivery. All right, so we had a few things in mind for the dollar. We were looking for the beginning of the week, the middle of this up candle, which is a bearish order block. We traded up into that, rejected it really nice, and we were waiting to see if we were going to come down in the middle of this order block here. And we said that if we lost the middle of this down candle, which is a bullish order block, drawing that out in here. If we lost that, we were going to close in this range. Okay, we did in fact come down into that really nice. Yesterday it touched it. I was waiting to see if we'd go a little bit further, and we did that today. You can see that happening over here, 97.18, which is the top of that range, which is the very high on this candle right here. That's why it's being highlighted in that blue shaded area. So the high is 97.18. We transpose that level here. So you see we dipped down into it here. We bounced again in here. While price is expanding on the daily chart like that, and this is what we were talking about the other day when we were trading the setups for the pound dollar, we are not looking at the intraday chart to trade on. We're actually using a higher time frame. And if we can trade the setup off of a daily or a 4-hour, it's ideal because we're really looking for the liquidity found on those higher time frames, and it's going to be a larger draw on price as a result. So we're not looking for these little tiny micro moves. So if we have the weakness in the dollar as we've seen here, we also had several areas expectation on the upside for euro dollar. So euro dollar, we had the low on this up candle here. Let's take a look at that. Okay, so we have 111.05, and that's the very low of the shaded area in here. And here's the upper portion of it being the body or the opening of this up candle. Okay, coming in around 111.44, but I rounded it to the nearest 5 level, so it's 111.45. We went right to the middle of that range. Notice that? Went right to the middle of it. Now, you can argue and say, well, that's because it went up here and hit these wicks. It might happen like that sometimes, but here we're looking at it's the middle of this range of this entire candle's wick. So where the candle's opening is here, down to the low, and then we zoom in so you can see a little bit better. So this candle here, you take the little box off here, you can see it a little bit better. This entire wick, that's the equivalent of a liquidity void. Okay, so it's a lot of open space in here. And if you put that back over here, that's the reason why we basically went up in the middle of that here. Now, it doesn't mean it's ended. It doesn't mean it can't go up to 111.45 or even go even higher. It just means that was the objective we were looking for should price get above that 109.65 level. Now, it's interesting to see how price did come back down, hitting this bearish candle, which is a bullish order block, and then start rallying up and closed in this liquidity void here. So we had two levels in mind for the euro dollar on the heels of potential weakness if we lost the bullish order block here, right here. That would open the doors for the euro dollar to trade up into this shaded area. Okay, so for those that have gone through my pre-tutorials, okay, you can see how we use the dollar index to give us bias. And it doesn't have to be a 6-month bias. It doesn't have to be a intermediate term bias. It just means where's the most recent liquidity and where's it most likely going to go in the next couple of days. So if you can get a horizon of 2 to 3 days in your trading, and that's nothing bad about that. And a lot of you are actually saying you're frustrated because you can't see where the market's going to go for the full week. And I'm telling you, I don't know that. And that's why I'm focusing on trading on Tuesdays and Wednesdays, because think about what that does. I'm waiting to see what the insight is given to me between Sunday and Tuesday's London Open. With that said, if I only trade from Tuesday, London Open, okay, that gives me what? Tuesday, Wednesday, Thursday. And I really don't like to trade on Friday. So I'm looking for a horizon of basically 1-day trade or what it's going to do on Tuesday up to Thursday, which would be a 3-day duration. So my horizon really, where I'm, in my opinion, the best in terms of my analysis, is my scope is about 3 days. I'm really, really, really efficient with 3 days time horizon. I can be right long term But if you really look at what I've provided in content over the last 6 years, I really excel in that weekly range idea. Most of my highest precision is in that realm because that's my trading model. When you go through this mentorship, you're probably going to see things by using these tools and these concepts, and you'll be able to say, you know what, I can appreciate day trading, I can appreciate the short-term trading, but I really think that I can be a buyer down here on the daily chart and wait for that move up here, and that's like my niche. That's what some of you are going to end up doing. Not all of you, not the majority of you, but some of you will. And don't discourage yourself out of that, because if you feel led that direction while we go through this process of teaching all these things, that's exactly what the outcome should be. You finding your specific model. Okay, so while it's important to know that even though we can expect these price levels up here, sometimes my trading model or what I'm looking for may not provide me an opportunity to be in that. But some of you actually will be in that. And that's the benefit of learning these tools, because they're applicable to all different time frames, and it allows you the freedom to form fit the analysis concepts into the style trader that you want to be. We're not rigid to the point where it has to be this and only this. It has to be trading on a 30-minute chart. It has to be trading on a 5-minute chart. The ideas are actually universal, so it provides you a lot of freedom, which I think is unique, because if you go and you learn other trading systems or approaches, they give you these stilted rules where you can only do this if the MACD does this or if the stochastics does that reading, and they make all these boundaries and perimeters. You don't have to do that with price action. You just need to know what time frame makes sense to you because of your ability to get in front of the price. If it's too short of the time frame at 15 minutes because you're doing a job or you have a business you're managing, obviously you may not be able to do that, but everyone can trade on a daily chart. Everyone can. And you can trade on an hourly chart. You can trade on a 4-hour chart if you have other things that tie you up. But when you get into anything less than an hourly chart, it's a little bit more challenging. With that bearish dollar, we were looking for the next upside objective would be this candle in here, and its candle's opening is that 123.99, which we were looking for 124 big figure. And if we got through that, we would look for this range to close in up here, and that's what we have noted at that 2688, basically 2685 to 2690 big figure, and then it would be the opening at 2730 as your next upside objective. We were looking for the buy stops the other day as an objective for our trading exercise. Price did expand up, swept it, came back down into previous old high. Okay, the old high is here. Now, with that said, the model is when we have old highs and old lows. Remember what we were talking about for the September content, what to focus on, what you should be focused on right now. By doing these ideas in conceptual basis, telling you, okay, look for old highs and look for old lows. Okay, by itself, it doesn't mean anything. There's ways of using previous day's highs and previous day's lows as a trading model all unto itself. You can be a buyer or seller and take profits at the previous day's highs and lows as well. They can be entry points. They can be targets. But how you work within market structure and using institutional order flow in concert with one another, it'll give you, some of you, like I mentioned earlier, that will be your trading model that you'll arrive at. So I'm not teaching you every possible scenario that you can use these tools. In fact, the ones that I'm teaching will actually help you frame your unique trading model, where you'll slightly do things different in regards to what time frame you use to draw that specific information out. It frames your setup. I'm only promising, I'm giving you what I personally trade with. But you're going to invariably come into this and say, okay, well, I can see the benefit of doing that, but I like it more in this format where the chart time frame is this, and I can see that setup, and it makes sense for me because I can trade this duration because of my life. The things that goes on in my life permit me to do that. Well, if we look at this the old high back in here, let me put the delineations on here. This was the high on November 1st. Okay, so price trades through it, which we were looking for that expansion here, looking up into the 24 big figure, but more importantly, before that, we were looking for the buy stops over here, the 2330 level. what that high is so you can see it. Okay, yeah, 23.29 rounded to the nearest round level, 23.30. That's why we have this level over here. Price reached through it, not by much, then came back down. And what did it retrace back down into? The November 1st high. Okay, so the November 1st high. So when price trades away from that, okay, when price moves away from that, what we're looking for is the next area of institutional buying. So what does that look like? We have to wait for the market to give us a clear indication of where new buying should come in. Well, we don't see so much of it in here, not on the 30-minute chart, but you can go down to a lower time frame and see the retracement in here and in here as well. But I'm going to focus primarily on this here. The November 2nd high, which is another daily high. Okay, remember, go back to September notes. Previous highs and lows. Okay, daily highs and lows. So we have this high back here. I'm going to borrow this line and put it right on it. So we have the previous day's high here. Okay, the market starts trading on the 3rd. Here's the midnight candle. The market rallies up, and it goes through the previous day's high. Now, this is for your notes, okay? This is really important. Previous day's high, November 2nd's high. Price goes through that, so it shows a willingness to want to go higher. Then it trades down again, okay? What's it returning back to? The previous area where it bought the down candles. It retrades back into those down candles as this bullish order block, and it rallies through. Now, here's the thing. Even if you didn't see this, even if you didn't see this on a lower time frame, 15-minute or 5-minute basis, the fact that we are looking for price to expand up into that 24 big figure, because that's what has not happened here yet. In other words, look at price right there. That's not happened. It hasn't happened to get to the big figure 124. So there's room to expand up, again, relative to the daily chart over here. We still had this time frame or this element of price action, this old high here, which is this high here on the 30-minute chart. Between that high and up to this level here, which is the opening on this candle, there is a gap. So price can trade up into that. So you're going to see or expect your setups to give you a bullish order block to trade into that little bit of an area. And your first objective will be the big figure 124. We know that's likely to happen because we see price break through the previous day's high. Now, I know some of you are thinking, well, why wouldn't this be a turtle soup sell? Because the underlying daily chart suggests that it's going to probably go up into this order block here. There's nothing else over here that would spell resistance because we've already cleared through the 123.30 levels on this candle here. And it didn't go lower. So what's it doing? It's pausing. It's waiting. That's what's going on over here. It's walking sideways basically until to give it a reason to go higher. So if we see price break above the high on November 2nd, and again, that's over here on the daily chart, we know that price is going to most likely expand up to the 124 big figure. Now, in your notes, and if you also went through my free tutorial stuff, you'll know that by trading the big figure, and there's actually a video on my old work where it is specifically titled Trading the Big Figure. The idea is it doesn't just go up to round numbers like 124.00. It wouldn't just stop there. It can, but generally the algorithm will reach through it and trade up to the next 20 level. Okay, that's generally what you'll end up seeing. And it'll go in grades of 20, 50, 80, big figure. So now think in terms of how I taught stop sweeping, okay, how it goes 10 to 20 pips on an intraday basis below a 15-minute time frame. Those highs and lows, generally you'll see the stops be rated in a grade of 10 to 20 pips. When you see big figures traded to, okay, if it's the first time it's traded back to that big figure, okay, it's usually expected to see it go about 20 pips. If it's in a bullish market and you haven't been to this big figure in a while, it will many times reach up to the 50 level. So if it's a bearish market and it's returning back to a old big figure or a 00 level, okay, we reasonably expect it to reach to the 20 level. But when it's bullish, we expect it to really spread through it because they're going to want to pair up orders that would be way higher up. But if it's in a bearish market, they're going to try to keep it capped. They don't want to create a new bull market. Okay, they're going to keep price at respectable levels. So you can still sweep above a big figure level like 124. And I'll explain this in a minute in case I've lost some of you. But the main thing is we see price want to go higher because they broke its previous high on this day's high here on the second. And that's this high right here on the daily chart. So in other words, this candle looked like this. It started coming up. It broke through it just a little bit above this previous high. And then it started consolidating near the previous day's high, which is what's being shown here. Now, this is the buy, returning back to the bullish order block, but watch what happens. Say you don't see that. Say you can't see it. You don't have the perspective to see it. The down candle here that gets ran through right here, that candle becomes your buy point. For institutional order flow, to get in sync with the gap to be filled up here, reaching for 124 big figure, as soon as this candle trades up, you immediately look for a reason to be a buyer back at that level. What level? The high at 123.49 to the opening 123.47. It's 2 pips. You can be a buyer at 123.50 or 123.55. Okay, you can be a buyer right in here. The next candle, right here, it opens, and look what it does. It trades down right into, what's the low on that candle? 23.48. The high on the down candle, which is a bullish order block, is 23.49. So we want 1 pip lower than it needed to just to get in this down candle. Now, again, if we're looking for this level to be a buyer, what are we doing with it in terms of spread for entry? We're adding 5 pips. So we're going to get in there around 123.55. And again, that right there would have offered it. You can do, when you're trading like this, you can do round numbers like it's going to offer you a little bit more in terms of stop placement. In other words, you could be a buyer at 23.60, round up to the nearest round level, and we'll teach a lot about when it comes to position trading and swing trading, where it makes it a little bit easier for folks that they don't have time to be in here nickel and dime in the market for ideal precision entries, which aren't necessary when you're trading big moves. But you can be a buyer at 23.60 as a short-term trader, okay, or if they're trading off of a daily chart. You don't have to get in here and nickel dime it. Just say, okay, I'm going to be a buyer at 123.60 or better. In other words, your limit order would be at 123.60. Now, let's say, for instance, that you are that type of trader. You can't be in here day trading. You got to have a little bit more time on your side. As soon as this down candle, okay, as soon as this down candle starts forming, and this candle forms right here, you got 30 minutes, okay? And this is, if this is done with a daily chart, you can do the same thing. But say you're throughout the day, you're close to your computer, or you have your smartphone near you, and you can do your entries off of that. You can use your alerts, like on MT4. You can actually set up an alert where it'll send you a text message when the high of this candle at 123.49, say it trades to 123.50. You can have a limit order, not a limit order, I'm sorry, alert to send you a text message. As soon as 123.50 is tripped, that would be immediately you go to your charts and you set up a limit order, okay, that you want to be a buyer at 123.55. So in other words, if price drops down enough to allow that, or 123.60, if you're a position trader and you can't be in front of the charts all the time, it's real easy because that's this old high over here. See the high? 123.62. Round number is 123.60. So if you were a buyer at 123.60 on a limit, anytime during here, the price is going to fill you. You're long. And then you can sit back and let the position run its course. Price explodes up, goes into the 124 big figure here, sweeps through it to the 20 level, to the 50 level. Well, no, maybe not the 50 level yet, but it does eventually here. The high 24.49, and then it sweeps all the way up almost to the 25 big figure, clearing out the body of this candle. So my question to you is this: knowing what we're talking about and showing here, because obviously I'm talking all hindsight and rearview mirror here, and I know some of you get irritated by that, even though you're learning a great deal by it. This indicates that we have a high probability of this range closing in. What range? Let's look at that right here. I should have had that highlighted, sorry. It's this candle's high that makes the low of the range, and it's this candle's low that makes the high of the range. And that's the whole area at which the liquidity void would be reasonably expected to get filled in. So going forward, that's what we're looking for. We've already traded up into it here. So we're looking for 126.90. Is that what that would be? The low? Yeah, 126.90 to 127 big figure is the next objective. So now think about what we're suggesting here. We're looking at several hundred pips of potential upside movement on British pound. So if that's the case, we have a lot of time because that trade idea is set up on what? A daily chart. So we can relax and settle in and wait for a new buying opportunity. You don't want to buy it up here. You want to wait and let it settle down a little bit because it's too much in a premium. And then you can expect to see price allow us an opportunity to get long and ride something in here. Now, we're not looking for the entire piece from where it's at here all the way up to 127. That's not necessary. We just look for something in between here. So now what this means going forward in our notes, we are going to focus primarily on wanting to be a buyer of British pound USD. That means we want to be looking for things that context lends well to being a buyer. In other words, bullish order blocks. When lows are swept out on the low end, in other words, like if we see similarities like this, we have a low and price comes down below that low, we are expecting that low to be a turtle soup long or a false breakout below that to absorb sell stops. The reason why they would want to do that is to pair up bullish orders to be long on the marketplace. So we're looking for bullish British pound USD, 127 big figure to 126.90. So that gives us context. Now, we see this in the British pound USD chart. We see it in the daily chart. It makes sense. We see it. It certainly shows a willingness to want to do it. Now, what makes it more significant or more probable is if we go back to the daily chart of the dollar index, does that give us reasons to expect lower prices on the dollar, or should the dollar find reasons to go sideways and consolidate? Because that's the same thing. It can consolidate and still allow British pound to rally, or the dollar could move in contrarian price action where it would be opposite or inverted. So in other words, as the dollar is dropping, you would reasonably expect to see that happening while the British pound's rallying. But it doesn't have to. It can be a consolidating dollar, and the British pound can still be permitted to go higher. That's the basis of how those pairs work or how they're built. So even though we have a little bit of range still in here, we may still end up coming down below the middle of this down candle or bullish order block, okay, and then come in and close in this range here. So we could see potentially 95.60s on dollar and close in all of this area in here, or it can consolidate in here and still permit the British pound to rally up to that 127 big figure. So all we're going to be doing is every day going into the charts, we're going to be looking for justification for the dollar not wanting to rally, okay, and go making a new high, at least not near term. But it'll support the idea that the British pound will have the freedom to trade up in here and hit that 126.90 to 127 big figure. Also, looking at the euro dollar, let's zoom in a little bit. If we have price move above and maybe challenge this old high up in here, okay, because that's the next area of stops. They're not going to just run here. They're not going to run here. They're not going to run here. The next area of upside liquidity on the fund level is in the area of the 113.80s, so it's above here. So we could see, again, a couple hundred pips to make a run on the liquidity on the daily chart with dollar potentially moving lower, or it could consolidate either one for the dollar. That's the same scenario. And then the British pound, we obviously identified where it may want to trade up into. And again, for those that don't really understand liquidity voids that strong, this down move here between these two price points here and here, between 26.90 and 24.85, price was only delivered on the downside. Okay, now think about that paintbrush analogy I used. The paint was applied to the canvas on the downstroke, and you're going to leave little pockets. And you know what I'm talking about. If you ever painted, there's going to be little areas where the paint wasn't delivered on the canvas efficiently. So price is going to want to come back up in there and close in that range between 26.90 and 24.85. Now, just because it's all it would require to get to 26.90, it doesn't mean that the price is going to stop directly there. It has a little bit of a void up here as well. This is just the area at which we look for on a minimum, because that's the nearest objective. It's the low-hanging fruit. It could potentially very easily trade up into the 128.70s to 26.90. But we have to take graduated steps. We can't just say, okay, well, from here it's going to go to 136. That's not how we do it. We look at where the market may easily reach up into next for upside objectives or down into next for downside objectives. Now, we would rather it not close in this liquidity pool here. The reason why is because this would be a real nice example of a breakaway gap, which would be classically seen in like stocks or commodities, where there's typically a session close and then it reopens the next day, and you'll see these common gaps, which is all what a liquidity void is. But because we're trading 24 hours and almost 7 days a week, the idea of actually seeing gaps don't appear on our chart. But the big ranges, and then you have these little wicks here and little wicks here. The gap is between this candle's high here and this candle's low. So we have that little area here as a gap. I'm looking at that as a potential breakaway gap, breaking away above this old high and running. So we don't want to see this void closed in. We want to see that remain intact. As long as it does, we're really bullish. If we come down and fill that, then I'm not so bullish right away, because then it wanted to come back down here and close that in. That's not necessary. If the market's bullish, it doesn't want to return back to 23.80s. It shouldn't want to do that at all. It should want to hold on to what it's got here and then expand higher again. That's what we're expecting going forward. And then finally, in summary, the U.S. CAD still being a mess around that 134 big figure. You guys saw I had a short on, and you can see where the stop loss were on those two positions. Shortly after sharing it with the entire internet, the market rallied up back above the 34.05 level we were looking for, stopping me out. Very marginal gain on the one position entry, and then the other one I got 19 pips out of it. So it still didn't run these sell stops. So I'm really interested to see what they're going to do with this, because the longer it stays like this, the more likely they're going to want to make a run into the 134.35s, which again doesn't make any sense in here. I'd rather see it come down and try to lose some ground. But this pair is really being held in consolidation a lot. But I will give you this study. Look at all the pairs that are coupled with the CAD, and you see what you see in studying that, because, for instance, you have pairs that trade against the CAD. In other words, instead of the dollar, replace it with another foreign currency. And most platforms don't give you a whole lot of choices that pair against the Canadian dollar, but because the Canadian dollar is in what kind of profile right now? It's in a consolidating. It's being held sideways, while there's other pairs that are being allowed to move freely, like the pound and the euro. And by having that, it allows you to see where there's big moves taking place. So while I was in a position trying to trade the major, which is a big tax break for me in the United States, and you'll learn a little bit about that too in this mentorship, but to get the best tax treatment in the U.S., you get it by trading the U.S. Pairs, the majors. And that's the reason why, again, I trade these more than I trade the exotics, like the pound yen or Aussie yen. I don't do any of those types of currency pairs all that much unless I'm being challenged to show that it does, in fact, work there. But I'm a little perplexed as to why the U.S. CAD is being held here. I don't really care as to know why. I just noticed that it's not wanting to move. So that means it leads to a deeper study in what pairs that are coupled with the Canadian dollar. You'll probably see some really significant price moves in those pairs, because the CAD's being held in consolidation while other pairs or other currencies are allowed to be traded freely. In other news, and in closing, just for coffee table discussion, I saw an article where Egypt devalued their currency 48%, and I think that's something to be watching, because these are some of the things that we were mentioning about in the free YouTube channel stuff a couple years ago, to start looking for these types of things to happen. You can get bailout consideration from the IMF if you have these types of events occur in your currency. So it really might be, well, it always usually is, but it may be for Egypt to get their the IMF, International Monetary Fund, to come in and prop up their economy. So, but nonetheless, we are in some really uncharted territories, especially with the U.S. So I think if you haven't really paid attention to politics, and I generally don't do that, but I'm really, really paying attention to it now. There's so many things to be keeping your eye on that could cause this market to be spooked and create some really crazy gyrations. So we want to be very mindful of that going into the elections and even the week after the election because of the fallout that may transpire. It may sound rather arrogant to say the whole world's going to be spinning on the heels of Hillary or Trump, but that's just a puppet. The person behind the scenes that's really doing all these things that control the economy and steer economies into doing certain things, they're the ones that actually are in force. It doesn't matter which president we put in there. I'm talking about the people that live in the states. If they start going crazy, that's going to cause a great deal of concern, and it's going to have an effect on commodity prices. And if it causes for the commodity prices to be affected, that's going to cause gyrations in the equities market, which is going to cause reverberations across the entire globe. And then you're going to have all these other things happen, which is a beautiful distraction to Deutsche Bank collapsing. There's so many things that everyone else is looking at, but you need to be paying attention to Deutsche Bank because that's the one that's going to start the whole downward spiral. And then while it's going to be amazing and all the opportunities that would be made available to that, they're going to be rather aggressive in terms of the duration is going to be short, but the magnitude is going to be big. And we need to be really paying attention to those scenarios because when they form, you can't be thinking, I'm going to load the boat up. In fact, you're going to be doing very, very small positions because the moves could be rather extraordinary. And I'll talk more about that as we get into next week. But the things that are on the horizon, this Sunday's pre-market video is going to be loaded up with a lot of things that you need to be paying attention to. And it's probably things that you haven't probably been concerned about or even interested in, but you need to be. You need to be watching it and being mindful of it because I do suspect that we're going to have a November-December event that's going to cause a lot of people a surprise. And for that means an opportunity for us as a trader. But I'll go into that in great detail on Sunday before the markets open up. And I'm going to close this video here. Hopefully we can get these folks that are still sitting around there. Some of them aren't always checking out Twitter, but I'm going to be talking to them on the ICT mentorship Twitter, not the one that has the underscore that I just created. I'm going to be speaking to them and making sure they understand what they need to do and spell it out in clear terms. So this is the last video everyone on that Twitter will see. Everything else is going to go by way of the new Twitter feed and through the forum. And if they don't have access to the November thread or the category that has all the November content in it, you'll be looking in from the outside. Okay, so I'm letting you know that you need to do some things to get the November content, passwords and all that. Even though your payment may have processed, that's not all you have to do. You have to tell me that you got the delivery of September and October's content, that you are satisfied with it. You need to type that out in an email. There is no email or survey. Okay, there's no survey that you have to go and download and then report based on that. I'm just asking you to send me an email stating that I delivered the September and October content to your satisfaction, and it was as described, and then I'll send out all the information for the November content. And we will be doing this every single month. And I apologize, but I have to do this because people are out here are trying to be, getting it for free. So with that, I'm going to wish you good luck and good trading. Okay, folks, just so you guys know, I'm going to be having this recording available to everyone that is in the other Twitter. It's also going to be available to anyone that has the link. So I'm going to ask you not to share that link with anyone because it's not intended for everyone else. The reason why I'm doing it like this is because there's a bit of confusion, and I expected it, but I think it's a little bit more than I was hoping for. There are people spoofing Twitters, okay? And it's real easy to get your avatar, and it's real easy to get a name that's real close to your name. And admittedly, I have quickly looked at certain names I've seen in the past, and I've added them. And once I add them, I can't delete them. The only thing I can do is block them. And it's become a little bit of a chore keeping up with that. Which is the reason why I tried to create the new Twitter to avoid that. So I've had my wife try to help me, and she's actually added folks again by quickly looking at it from the list I have. We ended up taking more people with the wrong credentials on. So we're going through the process of blocking those individuals. That's the reason why we were quiet today. And I apologize for that 11 o'clock session, so I'm making up for it now with the live one. There's also been, it looks like there's going to be a little bit of a drop-off in terms of our attendance, and that's okay too. You know, if you're not wanting to be here, that's fine. But I want to remind folks, I've said this before, during this mentorship, I'm putting a lot of time and energy into it and a lot of content. And the expectation going forward is before you get the new content, passwords, and access to the new month's content, you have to confirm to me that you have received the previous month's content and that it was as described. As you notice, the link for November has all of the lessons outlined before we get to it. So that way you can answer that, yes, it was delivered as promised. I had folks that are unwilling to give me confirmation that they received the content as delivered. And I'm going to tell you this up front, and I'm going to be very unashamed to do it this way. To do so, to be a part of this mentorship, just because you're paying your payment, that's not the equivalent of meeting the expectations of our agreement. The agreement is that, yes, you have to pay it. Then, after the delivery of 1 month, you have to confirm that you did, in fact, receive that you did, in fact, download it, that I have record of it on the forum showing that you went in and you downloaded it. So the only reason why someone would want to not supply a confirmation of delivery as described is because you're eventually going to try to do a chargeback. And I know this going in, and I also have 2 people trying to work it out now. So that's the reason why I'm asking you, and I understand. Why am I having to do all this? Why should I have to do all this documentation? Why am I having to do this? And why am I having to have so many passwords? I already warned you there's going to be people that's going to try to get this for free. And I'm going to try to resist that as much as possible. And I'm glad it's happening this early on, because if you're not trying to confirm receipt now this early, you wouldn't do it later on either. And I'm not giving the later lessons, making it accessible to folks that want to come in here and do Mickey Mouse money games where you'll pay the payment with the expectation of, well, I never was really there. I got sick all month. I was on a family vacation. I was out for a whole year. Okay. And I allowed the payments to process for 12 months, but I never really watched any of that. So I want all my money back. So I already know what's going on. Okay. And I've already told you there's no free rides. So the individuals that are sitting on the fence, whether or not you're waiting to send me the confirmation that you did in fact see and it was delivered exactly. Here's the problem is I have 700 plus people providing this, saying that it's exactly what it is. I've allowed PayPal to go into my website and see how structured it is. Okay, so it's a little challenging to meet that when you say that you didn't get it. When I have a log every time you logged in to the forum and every time you went in and you downloaded it, look at how many times that these files get downloaded. There's a counter to it, and your ISP number is attached every time you go into the forum. So if you can't afford $150, I already warned you, don't be a part of this. Okay? If you don't really think you're getting something of value, why are you letting your payment process to the next one? You're creating a great deal of administrative work for me which affects you. If you're trying to get it for free, you're just slowing the process down anyway. Okay, so seriously, get a second job. Okay, do a yard sale, do something. Okay, or just quit the mentorship, because you're not going to get the November content or the access to it until you give me an email stating that you were clearly satisfied with the delivery and it was delivered as described. I'm not in here trying to cheat people out of money. I'm not in here trying to hold you up with a gun and say, give me money for nothing. Okay, I'm doing a great deal of work, and even when I'm not doing videos, I'm still doing a great deal of work. Okay, so again, stop being so cheap, okay, and shady about trying to not wanting to supply me a business resource that I can prove to a credit card company that, yes, in fact, this content was delivered, you paid for it, I held my end of the obligation up, and we can continue forward. But sending me an email, okay, telling me that you didn't watch anything and you never saw any of this stuff, okay, because I'm insisting that you give me a confirmation of delivery, then fine, see you later. I don't want you here. Goodbye. Do what you got to do. Okay, but that's the reason why we're doing 12 months. That's the reason why there's multiple passwords. That's the reason why we do the things that we're doing with migrating to Twitter accounts, because there's people out here being straight up cheats, and you're trying to get it for free. And I've already warned you, this is what's going to happen. And it's unfortunate that I have to waste my time doing it, and those that are actually doing what they're supposed to be doing have to go through this crap. Okay, so again, this is a business. This is a pay for play. You have to be a part of this by membership. And the terms of use, you have to be able to show me proof that you did in fact get what you paid for, that you're happy with it, and then going forward, we'll do the same thing each month. It's simple. Why would you not want to do that? There's only one reason, because you want to be able to say to your credit card company or to PayPal that I didn't deliver as promised. And I ain't got time for you. Okay, if you want to play that game, it won't work here. You may get your first 2 months. You may get your October payment back by doing it. And if that's what you need, go back to doing what you got to do. Okay, but you won't be here for November, December, at the end when I give out everything I intend. So seriously, don't waste my time. Don't waste everyone else's time. And certainly don't waste your time, because you're not going to get past the next month if you don't supply it. It's that simple. So that's all I have to say about that. And if I can help if I can help everyone avoid all this and help myself as well, in January, I'm going to ask you all if you're willing to do 3-month payments. I'm not forcing it on anybody. I'm not insisting it. But for those that can do it, it would be a great deal of help in terms of the administrative work, because it's a little bit daunting. All right. So with all that, I appreciate your patience in listening to all that, but it is what it is. Unfortunately, we are internet-based relationship, so you have to be able to listen to everyone's business sometimes when it talks about things like this. All right, so